Hey everyone, Kevin here. I read a piece in The Economist over the weekend, and it was a really incredible piece on maybe why housing is acting the way it is, and I wanted to give you some of the bottom lines from this. So first, they observed that housing's been going up pretty much everywhere. In the 33 countries that they were tracking in sort of their housing indicator, all of them are up. You've got the United States up 15%, New Zealand's up 20%, and the reasons they give, which this is a comment that I regularly get on the channel, is like, why? Why are housing prices up? Why are they so high? And the reasons that they give are that people have record levels of savings, which is true. We have record levels of savings here in the United States as well. We haven't seen savings like we have right now since the 1970s, when we also had a very high period of savings, which is also kind of ironic and counterintuitive because it's like, wait a minute, saving great, like yields that you can get on your savings are super, super low right now. Why would people be saving more? And partially it's because of this big wealth transfer that has been happening from the government to people. I mean, people are getting more money, whether it's through unemployment or through stimulus or through their jobs, or they're just not spending as much because our economy is not as open. Now, I know that doesn't apply to everyone, but in aggregate, or sort of on average, American savings rates are higher, and we're seeing that in other parts of the world as well. The Economist also referred to, so they use that as one way to say, hey, if people are saving more, they have more capacity to put money down as a down payment. Usually a big roadblock for people when they want to buy real estate is coming up with that 20% down payment because they believe they need the 20%. Now, many people also know that you don't need 20%, you only need like 3.5% to 5%, which is how I started. I started with $9,000, which, a sidebar note here, is also really annoying when there are comments that are like, oh my gosh, Kevin, you're just like the wealthy landlords who are taking advantage of all the housing. Like, wait a minute. I started with $9,000, bought my own little house with now my wife, 50-50 going into this, and building our wealth by fixing the thing up and slaving over it. We took all the risk. We took all of the potential of failing, making $2,000 a month each to make a $2,000 a month payment. Yeah, it was bad. But we did whatever we could to get into real estate and housing. And as we started making more money, we added more and more rental properties and houses because it's a wonderful way to take crappy, beat-up fixer-uppers that nobody wants to live in and actually turn them into nice properties that people want to rent. So I don't know, there seems to be this obsession with all landlords are bad, but I feel like we're taking on a whole lot of risk, okay, to provide rental housing. And we provide high-quality rental housing, too, and I mean, knock on wood, but we want to come across as always as very nice landlords to work with. But anyway, another reason, going back to sort of the piece here, The Economist cited, in addition to high savings as one of the reasons that prices are going up, they also cited a reversal of trends. And originally, before the pandemic, we had a trend that was decades long of a shift of people moving to the cities because that's where the higher paying jobs were. In fact, before the pandemic, I would regularly say, look, if you want to make more money, go move to a big city. Like, where are you going to get paid more to change an outlet if you're an electrician? In the middle of Ohio or in San Francisco, in downtown San Francisco? There's no doubt, there's no question in my mind that you're going to get paid more in a city for oftentimes doing the same thing. But that is now really reversed, and we're starting to see, actually we've been seeing for the last year, a complete reversal of a decades-long shift. And the reason for this, The Economist cited, is people realize, wow, even if I have to commute a little further, I might not have to commute every day anymore. Even if we have to commute to the office 2 or 3 times a week, I don't have to factor in commuting every single day of the week anymore, 5 days a week. Because maybe we can have work from home days, or maybe we work from home most of the time and we only sometimes come in, or we don't come in at all. And so this reversal to the suburbs is really creating a supply and demand shift that we've never really seen before in the last decades. And even home builders haven't even built for, because nobody anticipated that a decades-long trend to the city would turn into a decades-long, or I shouldn't say decades-long, would turn into a trend now out of the city. So COVID really screwed things up as well, which definitely hurts supply and demand. And this is not saying that cities are losing value. No, don't get me wrong. Like, cities are they're gaining in price as well. Maybe not at the rate that the suburbs are, though. And so we're seeing real estate all across the board go up. But that's an interesting reason, too. So you had high savings combined with people wanting to move out to the suburbs. Then, obviously, and this is the no-brainer one, and incredibly low interest rates, which this is also not just the no-brainer, but it's also a risk factor. So low rates are not obviously super controllable by us unless we get a 30-year fixed rate loan and we lock them in. But we can. A lot of times when we're out shopping right now, we see, wow, I can get a 3.3% 30-year fixed rate loan. I mean, 3 months ago, you were able to get 2.75% amortized, fully amortized. So you own the home after 30 years, 30-year fixed rate loan. So even if rates double or triple, it doesn't matter. You're still paying that low rate. And so people are basically land grabbing these low rates in part, not only because they are low and things are more affordable, but also I honestly think that most homebuyers right now are like, I don't think rates are going to stay this low forever. So let's land grab now, get low interest rates now, lock in lower interest rates. And then when we have those lower interest rates locked in, hey, if rates go up, no problem. We're locked into a happy monthly payment that we can afford. Now, the problem that comes out of that is as rates go down, prices go up. For every 1% rates go down, price tends to go up 10%. And real estate pricing really can be heavily influenced by rates, obviously. It definitely ties to affordability. And rents don't tie to that, which is very weird. Like rents go up at their own pace, which in my opinion, based on my research, has been a lot slower than what housing prices are going up. But that's because of that crazy volatility. Like when rates go back up, we won't necessarily see rents come down either. We'll see. Every market is different. But at least right now, the trend is housing prices, whoop, and rent prices are like normal path. It's crazy. So you get this big sort of wedge right now. But people are still buying, again, to lock in those extremely low rates. Now, is it a risk factor that, yeah, rates are going to go up and then prices will come down? Sure. Totally. But a lot of the people who are buying right now are people who don't care about the short term. They're not trying to speculate on real estate. Over 80% of the buyers in most areas are home buyers. They're not institutions. They're not investors. They want to buy a home to live in it. So most of the competition when you're competing for a single family home is not an investor. It's not some foreign buyer. It's a local buyer like you or somebody in your community trying to compete against you. 8 out of 10 times, it is somebody like you in your community, a family or whatever, trying to compete for that property. To cast it as this invisible enemy of this investor or this foreigner who's coming in with all this cash is actually incorrect. Now, how do maybe your competitors get cash to beat or win deals with cash offers? Well, oftentimes it's because they've already been on the train of real estate. And they've built up equity in either stocks via margin or can draw on their equity via margin on stocks, or they've built up equity that they can take a credit line against, or they have business lines of credit. Most people who are buying cash right now are just refinancing as soon as they close. Cash is just sort of a way of rearranging their credit lines, buying cash and then basically refinancing later, which is exactly what I did. This summer, I bought, there was one particular house I didn't have the cash for. I really wanted the deal, and they said they'd only go with it if it had a cash offer. I'm like, oh my gosh, what do I do? I actually pulled margin out of Robinhood, $50,000 a day, which was the max margin I could pull out of Robinhood. And then until I had like $525K, and I used that to buy the property, cash. And then I fixed it up, and a month later, I refinanced it and locked in a 30-year fixed rate loan. And then paid off my margin again. Now that's risky, but it's also an option. Now, of course, that hurts people who are just getting started, who haven't built their assets or built their wealth yet. And that sucks. But that's just the competitive environment that we're in right now. See, like low housing prices, unfortunately, it's not like there's a societal reason for them to be high or to be low. Even though we want to say like, hey, look, somebody making $50,000 should be able to afford a house, that might not necessarily be true, especially if you're living close to a city, or you're living really close to public transportation, or you're living at a coastal city. In some cases, if you're making a lower income, unfortunately, that does mean you have to kind of broaden your scope and maybe move inland more. But fortunately, that is offset by the benefit of now hopefully less commuting. It's definitely tough, but that kind of reshuffling is something we're seeing. It's kind of similar to what happens in my opinion, when all of a sudden tech stocks go in favor. All of a sudden tech goes in favor, tech and EV go in favor, Tesla goes to $1,000. I mean, a lot of people going, man, this Tesla's not affordable anymore. It's not an affordable stock anymore. I thought it was expensive at 600, now it's 1,000. This sucks. It should be less so I can buy more. Sure, I want Tesla to be less too so I can buy more. This doesn't mean it's gonna happen. So anyway, then the Economist goes on to say that there are a lot of cities and municipalities and even central banks that are worried about exuberance in real estate. However, the Economist actually counters this by saying that house prices today don't actually threaten market stability. The reason for this is they found that of the top 30 banks, actually it might have been 33, which I guess that might mean that they tracked top 25 countries for real estate pricing. But anyway, ignore that part there. So they tracked the top 33 banks, and they found that if real estate declined 25%, all of a sudden, like interest rates shot up 2.5%, let's say, and housing prices fell 25%, the Economist found that the top 33 banks around the world would still have 50% more cash than they did going into the recession. On top of that, borrowing is actually surprisingly restrained because underwriting is so tight. Now, they didn't go into much more detail on this, but I do recall a Wall Street Journal article that I've also reported on before, and the Wall Street Journal article said, of the people who were doing refinances, back in 2006, 7, and 8, when people were refinancing, 90% of people were doing cash-out refinances. So they were taking their equity out of their home rather than just lowering their rate. So when you hear cash out, literally, it's like you're getting cash out of your piggy bank of your house. Today, of the people doing cash-out refinances, only 30% of people are doing cash-out refinances. So you got way less of this speculative borrowing. Even though it seems insane, you have way less of the speculative borrowing. Then the Economist found that new lending at high loan-to-value levels, so LTV. So high LTV would be like 5% down because you have a high loan, 95% to your down payment, 5%, or 10% down, 15% down. Those would be high LTV loans. In Great Britain, they found that new high LTV lending is 1/3 below the top limit for high LTV lending. So as a country, they have a limit that says we will not do more than this many high LTV loans. And right now we're 1/3 below that, which is interesting because really you're just seeing higher quality, higher, lower debt individuals borrow. And is that necessarily fair to everyone? No, of course not. I mean, the median wage worker gets screwed. Probably anybody almost working hourly, unless they're in tech, is getting screwed. Well, maybe I shouldn't say hourly because there are a lot of people who do get paid a whole lot of money hourly, like think of some attorneys. So maybe that's not the better way to put it. I would say more the people who definitely are getting screwed are anybody in direct touch with the public. Whether that's, and I hate to say it, but police, firefighter, retail, hospitality, teachers. It's very unfortunate. And a lot of cities are considering affordable housing programs and expanding on affordable housing programs to help try to solve this imbalance. But really, what we need, and I tweeted about this, and this is sort of my belief, is separate here from The Economist, and I always like to separate when something's my opinion versus when it's from an article. So let me jump over here. So here's what I wrote on Twitter, which follow me on Twitter if you don't yet. It's @RealMeatKevin on Twitter. Take a look at this. Okay, here we go. Housing affordability is bad. It robs people of the ability to build wealth with housing. This is true. Like building wealth with housing is so important. Wishing for a housing crash, however, is misguided. And there are a lot of people like, I want it to crash so I can finally buy real estate. But that's misguided. Sure, could prices crash? Sure. But at least right now, I think it's like wishful thinking. Anyway, then housing will go down as rates rise, but for now, a mega crash like 2008 is unlikely. No, prices can't keep going like this forever. This imbalance we're seeing, it won't go on forever. We're gonna build more. We expect housing starts at the end of this week when they come out to come in a lot higher. I think they come out on Thursday. And we do expect that in a few years, these supply shortages will really balance out. And we're really gonna see that flattening, hopefully sooner than the next 2 years, but we're really gonna see that flattening of this madness in the real estate market. The real solution to the housing crisis? Better transportation, like Elon Musk's loop around Vegas, but also out to the suburbs. Like, think about it. If you didn't need a car and you could just hop in a Tesla loop and it just zipped you over to downtown and then back out to the suburbs, my gosh, you wouldn't need to own a car. You could live further away. It wouldn't make that much of a difference. The Tesla automation loop is really going to be a game changer, and I think a lot of people are underestimating how important it is. And this is why I'm so heavy in Tesla too, more housing stock via 3D printed homes or conventionally built homes, but more of it. We need more homes. It's very simple. There is a massive shortage of homes. We just need more. And better education. When people graduate high school today, they can't get a decent job. That's broken. America's high schools are broken. We should be teaching employable skills in engineering, trades, sales, data, tech, and more, not Lady Macbeth. That's how you begin fixing housing. Unfortunately, those are dynamics that are going to take decades to solve. And so, yeah, I mean, when will the future of affordable housing come back? I don't know. I really don't know, and it is unfortunate. Again, yeah, maybe rates will go up, but here's the problem. Even if rates go up 2% and housing crashes 20%, okay, well, they're just going to be just as unaffordable for the person who can't afford a home today. It's like, yay, prices went down 20%, but oh my gosh, the payment is the same as if it were 20% higher. Right? Like, if you're hoping for an interest rate crash and you're waiting to buy real estate for an interest rate crash, you're not going to be getting a better lot if the only reason is interest rates going up. And again, the types of people buying homes right now aren't the ones that are at a high risk of defaulting. They're not no income, no asset, no job loans, right? These are highly qualified individuals who are able to buy right now. And it's much to the chagrin of many of the people who want to be buying, to be building their wealth, which is what I built this channel on, building your wealth and getting started with zero. And that's why I have a real estate investing course that teaches you the fundamentals of going from zero to millionaire. It's also why I have a stock investing course that teaches you the fundamentals of investing, not just copy this trade or that. Very important. Anyway, let's see, what else do we have here? The Economist also mentioned that a lot of supply coming will help, but you're going to end up seeing a lot of that supply also being built outside of coastal regions. And the reason for that is outside of coastal regions, you have much more lax building standards. And so expect a lot more housing to come up, yes, in the suburbs and away from those more concentrated areas where city regulations are much tougher, and I cannot agree more. City regulations are something else around the coast. Anywho, check out that coupon code down below for the programs that are helping you build your wealth the real way by investing properly with stocks and real estate. Check those programs out down below. Folks, thank you so much for watching, and we'll see you in the next video.